Giving Tuesday is December the 2nd, 2025, and year-end donations are just around the corner. So this week on the podcast, let's talk about how to give with purpose. Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist, Phil Putney. Now let's get rolling with today's show. Hey everybody, welcome to the podcast. Thanks for hanging out with Phil and I here on Phil's Tax Hacks and Other Retirement Facts. And if you are of giving nature, then this might be an episode for you. And if you're not, well, maybe you should reconsider. I don't know, but we'll talk about it, right? How you doing, my friend? You doing all right this week?
Doing good.
That's good. We were laughing, you and I, we were like, I think our microphone, your microphone was on the wrong setting on last week's episode, but that's all right. It still sounded pretty good.
Yeah,
but
technology. You gotta love it.
It's always something, right? Even when it says it's working, it's not actually working. So
that's right. You got to check and double check it.
You got to check and double check, kind of like a retirement plan, right? That's why That's why you go back in and check things. So, but let's talk about the some of the pieces of giving if you are charitably minded, I should say.
Sure.
So let's start with the why, right? Is that something that you enjoy doing, and how big of a we kind of talked about feelings on last week's episode. This week we're specifically going to talk about charitable giving, but if that's important to you, are you sharing that right up front with your advisor?
Yeah, and I mean it's important for an advisor to understand. I mean, this is a question that I bring up during the initial meeting with a prospect, just to understand, is charitable giving important to them? Is it something they want to build into the plan? Mm-hmm. For a lot of reasons. I mean, number one, it's call it an expense, but it's a line item, right? I mean, if you're planning on giving X amount, maybe you donate every year, you tithe or, whatever your giving is. So we've got to build that in and understand that that's important to you. It's something you want to build into your base expenses because it's also potentially important from a tax standpoint, and that's part of the reason too, we ask is that if it is, there are some significant advantages you can gain from a tax standpoint if it's planned for properly. But I mean, the first point to realize though is it's got to be important, so you don't give because you're looking for the tax benefit. That's, there you go. It's not going to get you the right answer at the end of the day. There are potentially some tax benefits, but that shouldn't be the primary reason to give. If giving's important, the why, then I don't need to know the why, but if it's important, I just need to know that it is important to you and you want to build it into the plan. Great.
Yeah.
Then let's have a discussion on how to do it most advantageous to you.
Yeah, it's funny. People usually will say retirement is a math problem. I've been kind of saying for a while, Phil, I think it's an English, instead of a math, equation, it's an English problem. It's a who, what,
it's both. Yeah.
It's a who, what, where, when, why, right?
Yep.
So, when, that's another piece of this, like, when's a good time to be optimal? So we are that inclined. We do want to do it for, good reasons or whatever the case is. Now, so when's the best time, or when can we be optimal?
And that really kind of comes down to the amount that you're giving compared to your overall strategy. And again, more from a tax standpoint, right?
Okay. All right.
So looking at it through that tax lens, I mean, if you're not giving enough, that when combined with other itemized deductions, like state and local taxes, mortgage interest, if you still have it, to get above that itemized or that standard deduction threshold, well, then maybe the when's going to make more sense to kind of what we call bunch the deductions.
Gotcha.
So maybe you don't give this year, but next year you double up.
Okay.
Or do something of that nature so that we get more of those deductions in 1 year.
Yeah.
So that now we can get you above that standard deduction threshold and you get a benefit.
The Tax Smart Retiree is your comprehensive guide to mastering tax efficiency for a flourishing retirement. You will find indispensable advice and actionable strategies designed to enhance tax savings, maximize Social Security benefits, protect against market volatility, and develop a customized retirement plan. To get your free ebook, click the link in the show notes of today's episode and download your copy of the Tax Smart Retiree right now.
I was going to say, would that walk us into the how much then, a conversation of that?
Right. Well, it could.
Okay.
Yeah.
All right.
So depending on, again, how much you're wanting to give, that's going to play into it too. So
like with changes to the OBBA,
the
OBBA with the one big beautiful bill, how much it has changed a little bit. There are some shifts there.
It has. It has. So, I mean, this year, so Obaba was one of those things that there's.
I just want to say that now, Obama.
But it's one of those bills that's got, well, there's pieces of it that come into effect this year and there's pieces that come into effect next year. So with charitable, it comes into effect next year. So this year, you're still kind of running on the old rule, so to speak.
Right.
So with the how much for next year, the things you got to keep in mind is, number one, now there's a floor.
Okay.
Right. So if you think back to how medical deductions work for an itemized, you had that floor. It was 7.5% of your income. For charity, it's not as much. It's only 0.5%, but it's still a floor, right? A hurdle that you have to get over. So I mean, if you're making $100,000, then the first 500, and again, it's not a huge number, but the first $500 of your donations don't even count, right? So to get into the amount that is potentially deductible, you have to give more than 500.
Okay.
So again, it could be one of those, like we mentioned before, one of those bunching type scenarios that, you want to get over that hurdle, that floor by enough to make a difference.
Yeah. Yeah, that's a good strategy for people to consider, right? Is maybe you double up one year and you're a little bit different the next year. So again, all those kind of pieces factor in. Go ahead.
Well, there's lots of factors in there. The other thing too, especially if again somebody is very charitably inclined and it's something they want to build in, knowing that we have these different thresholds of now, especially having that floor, and we've got this higher standard deduction threshold we have to get over. Maybe it makes sense to fund a donor advised fund up front. So you're giving a substantial contribution to the donor advised fund in 1 year.
Mm-hmm.
Therefore, we're well above those thresholds and we can take advantage of it from a tax standpoint. And then in future years, you start to make donations from the donor advised fund to your charity.
What is that, Phil?
So there's all sorts of options in there. So
quickly for folks, what is just a donor advised fund? They may have heard that term, but not understand what it is.
Yeah. So a donor advised fund is in and of itself a charity.
Okay.
So it is a charitable organization. But how it works is it's a charitable organization that you control. So when you donate to a donor advised fund, you get a deduction for the amount that goes in that year. So that's where the tax benefit comes into play. But ultimately, it's kind of a conduit type charity. Think of it that way, right? So it's a charity. Its charitable purpose is donating to other charities. Mm. But that's where you come in now, is that you get to pick who those charities are in the future and when.
Okay.
So since you got the benefit up front when the money went in, you don't get benefits in the future from a tax standpoint when you make donations from the donor advised fund. So it's a way of you kind of bunching and getting a substantial deduction in 1 year and then not totally giving the money away and losing control, so to speak, of that money up front. You've think of it almost like your left pocket, right? You've taken money out of your right pocket, you put it in your left pocket, and from now on, you're going to make donations to charities from that left pocket.
Okay. All right.
So you still control when and how much. The downside to it, though, is that once you've donated money into a donor advised fund, it's gone. It's not yours anymore.
Okay.
So you can't, in 2-3 years down the road, say, I really changed my mind. I wasn't that charitably inclined. I want the money back.
And the pocket has been closed. You can't go back in.
So it's a pocket that you can put money in. You personally can't take it out, but it can go out to charities.
I gotcha. So, okay. Very cool. Yeah.
So it's really used. There's a lot of uses for it, but it's used really for this tax side of it, right?
Okay. Yeah.
I mean, one of the bigger advantages to it is you can take an appreciated asset. So let's say you invested in NVIDIA back in the day, right? And paid $2 a share. Now it's worth what, 140, 50.
You're a happy camper,
So you're a very happy camper, but if you sell that today, it's going to cost you a boatload in taxes.
Sure. Yeah.
So you can take those NVIDIA shares and donate them to the donor advised fund.
Gotcha.
So this is where you get a double benefit because you get the donation of the value, but you don't have to pay the tax.
I'm glad you brought that up because I was going to ask you, of my English, question here was what's the what factor? Like how are we writing this? Like, how are we sending this money? Are we cutting a check? What are we doing? That's one way to do some things. There's some other ways. Yeah.
Yeah. So donor advised fund. I mean, if you're funding it, you can fund it with cash. You can fund it with individual securities or mutual funds, ETFs, whatever you hold. You can fund it with real estate. Let's just say you've got a rental property. Some donor advised funds will accept the real estate. They sell it. Now it's a liquid asset that you can use to donate with.
Right.
So, those are one ways. Another way is you're just making direct donations to a charity, either in cash.
Yeah, like if you're not using a donor advised fund, you could still do other ways. You could donate cash. You could do QCDs, right?
Right. You could still donate securities to just an individual charity too. Or another way is, to your point, once you reach age 70 and a half, and this is where it gets kind of crazy because it used to be related to required minimum distributions, which was 70 and a half.
Right.
Now it's 73 or 75, but they still left the QCD, the Qualified Charitable Distribution, at 70 and a half.
Well, they got to keep you guessing.
The left hand didn't know what the right hand was doing. Imagine that.
It was in the pocket. It was too busy in the pocket. So
that's right. So yeah, once you reach 70 and a half, if you're still donating, you're charitably inclined, you can start giving to the charities from your retirement accounts. And the key there is that it has to go directly from that IRA to the charity. So you can't take a distribution and then give it to a charity, because then it's a taxable event to you and you're back to, do I get a donation deduction? If it goes directly from the IRA custodian to the charity, then it's not income to you. You don't get a charitable deduction, but you weren't really benefiting from it anyways. So it's a way of potentially taking some amount of your assets that are going to be taxable if you were to take it and make it a tax-free benefit to you because you're using it to satisfy charitable donations.
Gotcha. Okay.
And so, it qualifies as part of your required minimum distribution when you get to that age.
Right. It can satisfy that. Right.
Right.
Or part of it, depending on what you're doing. Yeah.
Mm-hmm.
So it sounds like, Phil, if you're charitable minded and the idea of giving is appealing to you, it can be simple and it can be complex. So what you're trying to do really probably requires the use of a professional if you're doing anything more than the very simple, here's a check, right? Right.
Yeah. And this is precisely why I ask clients up front the question and delve into it a little bit, just to understand that, hey, if this is a priority to you, it's part of your budget, so to speak, right? You plan on giving X amount a year, or if you plan on giving X amount at the end, well, this is a better way of doing it. Let's maybe accelerate it and you get the benefit today. But if I know that going in, now we can have some discussions around, well, what's the best way to make this work for you? Still satisfying that charitable, intent that you had, but let's do it in the most economical way to you so you can potentially get a benefit.
Yeah.
So,
yeah. Why not? Right.
Yeah, absolutely.
Yeah.
And that's my role as the advisor, is to make sure that whatever we're putting together is coming out with the best benefit to you.
Yeah, because obviously give with purpose, right? Plan with wisdom, but your generosity, is awesome. But let's be efficient as well, like any other piece. Why not? If you've the motives are already where you'd like them to be, then go ahead and take the advantages that are built into it for you to take advantage of. There's no harm in doing that. And you're still helping people as well as, providing some, benefit to yourself. So at the end of the day, it can be super simple. It can be super complex. Something like a donor advised fund, certainly get some help. Talk with your advisor. Certainly you got to talk with your advisor on how to do, QCDs and taking care of all of that stuff. So if you need some help, reach out to Phil. As always, at philstaxhacks.com. We'll have links in the show descriptions below. Just make sure you click on the link and get some time onto the calendar. And reach out or, talk to a professional in your area, but talk to somebody, right? Make sure that you are having that conversation. And don't forget to subscribe to us on Apple, Spotify, and audio form. Or, of course, right here on YouTube, hit that thumbs up and notification bell so you catch new episodes when they come out. And we'll see you next time here on Phil's Tax Hacks and Other Retirement Facts.
Phil? Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.